All right, we are live. Good afternoon or good morning, depending on which part of the world you're living in. Ryan and Sonu here. Before we go any further, Sonu, you want to hold up our superpowers? You want to hold those up?
All right, yeah. Hey,
yes.
Can't go wrong with these.
You can't. I want to tell why we are drinking milkshakes, Sonu, other than we just like chocolate?
This goes back to the first time. I think it was the first time you and I were doing one of these. This was back in Vegas, actually. No better place to, reminisce about than Las Vegas. But yeah, no. So I was looking for Ryan, just so for everyone listening, right? We have about 40 minutes or something to go to our presentation. Yeah. And, I was searching for Ryan. I was like, where is this guy? And then I see him at a bar. It turns out it's a milkshake bar. Right. And so he was there having this massive milkshake. I was like, wait a minute, I should get one too. And since then, we've always gotten one before our presentations.
Yeah, he said, "Aren't you nervous?" I said, "No, not really, not really." But that's all right. So let's get it. We do have our milkshakes today. So listen, we are so glad and honored. So many people are taking time out of their busy schedule to sit down and listen to what the Carson Investment Research Team has to say about 2024 and our outlook, which we just released literally, I guess today. You could say today. So we're really excited about that. Sonu, there's a lot of ways we can go with this. I think I want to talk a little bit about kind of where we just were. Now, I don't see the slides. We put the slides up. How does this work exactly? Perfect. There we go. There they are. Oh, you're driving it, right, Sonu? Yeah. You're driving it. There we go. So, there's me. There's
we need to tell people who we are, right?
Yes. Chief market strategist. Been with Carson for like 19 months now, give or take, and have a blast. Just you're gonna, hopefully you've listened to some of the things we've been saying, but I get to talk about markets, get to go on TV, get to write, get to think. I get to create really unique content that hopefully can help our Carson partners and help their clients, just help people in the industry in general kind of understand what's going on. Because believe me, it's confusing. It's scary at times. We're aware of that, but I love to try to break things down to make it digestible and, easy to use for your average investor out there. So hopefully that's what I do all day. I mean, every day is different, right? Today I'm drinking a milkshake. You never know. Yeah.
And you spend time talking to me, and I spend time talking to you, right?
Yeah,
I'm Vice President, Global Macro Strategist. That is my official title, I suppose. But I lead our asset allocation team, manage portfolios together with Ryan and our amazing Carson Investment Research team, especially Barry Gilbert and Grant Engelbart. But, just to give you a sense of what I do day to day, well, this morning I spent the time with Ryan, Grant, Barry, talking to our advisors about where we see the world, where we see, our portfolios, how they're moving. And then inflation data came out, right? And so I was, buried under the hood of economic data. I think the big difference, though, Ryan, safe to say, I'm not an economist, but I try to play one sometimes for good or worse. But the big difference, what we do here versus everyone else is, we are taking that economic analysis, the market analysis, all of that, and converting into portfolio decisions, right? And giving advice based on that. So I think that's a key piece of what we do here.
Absolutely. So sometime this evening, sometime between 7 and 8 o'clock Eastern time, I don't have an exact time yet, I'll be on CNBC discussing, again, pretty much what we're going to talk with everyone on this call about. I'll digest it and make it like 90 seconds worth. But, what makes us, again, special, I think, on the Carson Investment Research team, when you hear me talking about how we see the world, when you hear Sonu talking about the world, when you hear someone else on our team, that's not just us pontificating like you see so many people do when you look at the media or TV. We're really talking about how we're managing real money and how we see the world. And I think that's hopefully it adds a little bit of, we're on the same side of the table. Because again, if our calls and things do well, then believe me, everyone's happy, and the vice versa if the calls don't go so well. But we've had a pretty good run lately, Sonu. Maybe let's go there. And I will want to say this much. We are welcoming any and all questions. You can go ahead and type in a question there. Believe me, we might not get to all of them. We're going to try to answer them, but I want to be very clear. I will try to actually answer maybe as we go along, also to have a conversation going. If we mention a word or a phrase you hear, you think about, please feel free and send a question there. And if we don't get to all of them, we'll definitely get back with you, very, very soon with an answer there. So how do you sum up 2023? It was an incredible year, a lot of different ways. But I think, this time a year ago, where's my quote? I have my quote here. I thought this was an interesting quote. You've all heard the quote, "It's always darkest before the dawn," right? I think that summed up last year. I thought, who wrote that? So it actually, or who came up with it? According to the internet, where, believe it if you want. But the internet said Thomas Fuller, an English thinker from 1860, or I'm sorry, I don't want to keep saying 18. It's 1650. He's the person credited for It's Always Darkest Before the Dawn. Last year at this time, Sona, we were promised by many, many strategists and economists a recession. We were promised the bear market, that the market bottomed October 22 and bounced. Remember that? We were told there are new lows coming. Don't worry. The bear market's not over yet. We were told that. It was very dark. It was very, very dark. Our team took you can say a contrarian view, and we'll get into some of those things. And honestly, why a lot of them are still playing out this year. We didn't see a recession. We didn't see. We thought October 22 was the lows of the bear market. We saw some opportunity without a recession. But what I think is fascinating, you can see here, you've got Cardi B on Twitter telling us when's the recession going to start. That might be an indicator. You've got the strategist in the bottom right corner there, Bloomberg strategist, actually looking for negative returns last year. This is a year ago right now. That's after a really rough year, no question. Down 20% for stocks, real rough year for bonds. Everyone was on one side of the boat, and then I guess you also had, who's the next Warren Buffett there? If you don't know, he's sitting in a jail cell right now. So again, 2023 was an interesting year for a lot of reasons, but I think the thing that surprised me the most, Sonu, is how wrong everyone was. What surprised you about last year?
I think this gets to actually the title of our outlook this year is seeing eye to eye. Eye to eye. And part of the reason is, as you mentioned, look, we didn't see eye to eye with most of the people last year, right? Economists, strategists, they were all over the place over the last couple of years. COVID really messed things up, including traditional models of, I think how business cycles move and how the economy works. And in that sense, like this time really was different, right? It was different in that, like, the Fed raised rates really fast, 0 to 5%, 5.5%. But I think the big surprise was not an entirely big surprise to us, at least. There was no recession, and markets bounced back in a big way in 2023. But one thing, Ryan, I was surprised by is, look, we didn't expect a recession in 2023, but I thought, GDP growth, real GDP growth, would clock around 1.5%, 2%. Not amazing, but not too bad either. GDP growth looks to be between 2.5% to 3% in 2023 once we get the Q4 data. I mean, that's more or less above the trend of what we saw over the last decade. That's really strong, despite everything, all the headwinds, right? That's what surprised me.
Well said there. One more. You maybe go to the next slide, Sonu. Another one that surprised me, just how last year played to script. And believe me, we're going to talk about where we see 2024 very soon. We're just kind of setting the dialogue here. This is broken down by the presidential cycle, right? There's 16 quarters in a 4-year presidential cycle. We've seen a lot of bear markets end in October. A lot of bear markets have ended in the fourth quarter of a midterm year. Historically, midterm years aren't very good for investors. Well, those things played out if you think about 2022. What's really unique, though, Sonu, we were, again, told last year, 2023, the first half might not be very good. It'd be the second half when it's better for the economy, better for investors. We'll have that recession sometime early 2023. But history said, you know what? The first half, that's what we're sharing on the screen here. The first half of a pre-election year is usually pretty strong. Third quarter, hey, you give some back. Fourth quarter, you usually have a chase into the end of the year. That played out. I mean, that's kind of amazing to me when you think about it, Sonu. But here's where's it going from here, right? Our views on the on the stock market this year, S&P 500, we think it'll gain between 11 and 13% when all is said and done. This time a year ago, we came into the year saying between 12 to 15%. Well, that was much more bullish than most people. We upgraded that around the middle of the year when we did our mid-year outlook to between 21 to 25%. Sure enough, S&P gained about 26% on a total return basis. But as of now, we're thinking low double-digit returns make sense with no recession, and we think bonds will gain between 5 and 6%. So that's kind of our big level, how we see the world. If that plays out, I think we'll be in a pretty good mood. But you think about it here, Sonu, an election year, the last 10 times we've had an election year with a president up for re-election, stocks have been higher every single time. When you're up 20% for the year, like we were last year, what happens that next year? Higher 80% of the time with about a 12% median return. So better than average returns. One of the big questions we hear is, listen, last year was a big rally. We haven't made new highs in the S&P, everyone, for 2 years, okay? So one of the reasons we think this market still has legs, even after the huge rally last year, especially the fourth quarter, we haven't made a new high in 2 years. So we're just getting there. We think new high. I was hoping we were going to hit new highs today. I don't think we're going to. It looks like we sold off a little bit. Boy, we're close. We are really, really close. So just think about that. 2 years at an all-time high. Sonny, anything you want to talk about here before we move forward?
I mean, you mentioned the election, so I was just going to ask you, because I'm sure a lot of people are thinking about this, right? Like, how do elections relate to markets? Is there any connection? And the party in power, do your numbers, do they change depending on which party is in power, which party may get elected, not get elected? Any of that?
When I looked at that regarding like a first-term president, right? All first-term presidents, what's really fascinating, again, I'll answer, but I'll build a little bit. When you're down in a midterm year, like we were this time, the pre-election year, Sonu, has been higher 9 of the last 9 times, up like 20% on average. That's right about what happened last year. An election year has been higher the last 8 presidents when you're down in a midterm year. So that's the last 17 times when you're down in the midterm. The pre-election year last year and the election year are higher. Could this year buck that trend? I mean, maybe, but we're going to lay out why we don't think that's the case. So those are some amazing things. But then when I broke it down again by, Republican, Democrat, honestly, no, the results are quite similar. One of the things I think, maybe we move forward after this, but of course, who's in the White House matters. But we want to be very clear on our team. We think how the economy is doing matters more, right? Of course, the makeup of Congress matters. If you have a true big blue wave or red wave and too much power, one party or other, then you can upset the apple cart a little bit. But we have a pretty divided gridlock government, right? I mean, look at the Senate, right? It's darn close to 50-50 right there. We've got the smallest majority in the House in a long, like 150 years, I think, for Republicans. So the bottom line is a lot of gridlock. We think when this election's over, there's still going to be some gridlock, but just be aware, election years are usually strong, especially if the economy's good, like we're going to talk about. And, there's still some reasons to think equities are going to do pretty well.
Ryan, I know a couple of questions came on, and of course,
that's why we shouldn't talk politics. Let's talk milkshakes. Tell us your favorite milkshake. Let's talk about that. I don't want to talk politics.
I'll take chocolate. I mean, of course. I mean, I don't do anything other than chocolate. But thoughts on CPI report is one question, and the other was OER, owner's equivalent rent. You know what? I'm going to wait a bit. I'm going to put a pin in that because we are going to talk about inflation. It's coming, so I promise to answer that. But in the meantime, feel free to send questions in. We'll continue talking about it. Ryan, one big thing we've heard with the rally, especially last year, especially in the last 2 months of last year, is like, oh, this is a bear market rally, right? Yeah. But obviously, we don't think that. The bull market, as you can see here, we think it's alive and well. And a big part is obviously the market technical story is in place. It's momentum begets momentum. That's what I always like to say. A lot of your work shows that. The technicals look good, right? But here are the fundamentals. What are you looking at with respect to earnings, profit margins?
Well, a great point there. I mean, on the left, that's earnings, right? We're looking at record earnings this year. We're going to talk about the economy very soon, but there are a lot of tailwinds to our economy right now. And if earnings are hitting an all-time high and turned higher like they have, that's normally good for the economy. And that's normally really good for the stock market. So that's something to be aware of. On the right, we're talking about profit margins. We've been told for years now that profit margins are going to come back. Profit margins are going to come back to earth. Check that out. Profit margins kind of curled and gone higher. I mean, that says a lot about the ingenuity and agility, I guess you could say, of corporate America in general. But profit margins are higher. And when we don't have, but I also like to talk about CapEx, capital expenditures, companies investing in themselves, getting out there, building things, doing things to create higher productivity down the line. That is expected to hit an all-time high also this year. So when you kind of do that, it's like a trifecta. When those three things are taking place, again, it doesn't mean we're going to gain 25% this year, Sonu. In fact, we think the odds are quite slim. I mentioned after a 20% gain, what happens? Well, just so everyone knows, only once in history, it was 96/97, was the gain the previous year higher if you gained 20%. So again, that'd be like a 26-27% gain this year. Might not happen. We're not going to complain if it happened, but again, higher returns, specifically lower single. That makes sense. Lower double-digit returns makes a lot of sense to us here.
Right. No, absolutely. And I think that trifecta you mentioned is a good, as earnings season starts tomorrow, right? Literally tomorrow, Friday morning, JP Morgan reports, all of that. So, three things that we like to look at, especially from a macro standpoint: what companies are saying about forward earnings, what are they saying about profit margins, what's happening there. And then, as you mentioned, CapEx, that's what we don't show here, but it's a big piece of investment. Investment leads to productivity, all of that. So CapEx is really important.
And we did just get another question. It says, other than history, I mean, what leads to, or what indicators say no recession? I mean, some of them on the screen right now, right? I mean, we're going to talk about some more here. But the consumer, right? The consumer makes up 70%.
You want to go there? real quick? Oh, right.
There we go. Yeah, so here we go. So this kind of answers that thing for that question. I mean, let's talk about the one on the right, Sonu, because here's what we hear. Here's what I hear all the time. You hear it all the time. Interest rates were higher. Oh, they've come back a little bit. Interest rates are higher. People are just maxing out their credit cards. The economy's about to fall into an abyss. All the debt that's out there. Yet you're telling me on that right, and you're going to explain it, household balance sheets are actually one of the best shapes they've ever been. That's one reason we don't see a recession. You want to talk about the one on the right first?
Yeah, one reason we don't see a recession, and one reason, frankly, as I said, we got surprised last year by how strong economic growth was, right? Even in real terms, even after adjusting for inflation, the labor market's been strong too. But look at household net worth, right? That's in a very good place relative to pre-pandemic, or literally most of the periods over the last 30 years. Net worth, right, as a percentage of disposable income is 750%, right? The assets minus liabilities divided by disposable income. Before the pandemic, it was closer to 675%. Now, as I said, there are two sides to net worth, assets and liabilities. And, we normalize it. We look at it as a percent of disposable income in that chart on the right, just to compare apples to apples across time. So asset values, Ryan, have increased over the last 4 years. All of us are familiar with that.
Yep.
Home prices have gone up. Stocks have gone up 58% over the last 4 years for the S&P 500, and even deposits, right? Deposits in accounts have, sure, the government sent checks and all of that, but there are more deposits now than there were before the pandemic. At the same time, you look at the other side, liabilities. Liabilities haven't increased. They've been around 100% of disposable income. This includes credit card debt, mortgage debt, all of that, right? That's very similar to where we were before the pandemic. So then if you take asset values have gone up, liabilities stayed in the same place. That's why net worth has gone up. And I think that's a big reason why the economy's stayed strong and why we think it's likely to remain strong for the rest of this year. And even, to be honest, maybe even beyond that.
Great points there. Let's go backwards in time, if you will. Let's go back in time. I want to talk about this one just for a minute. Well, I already kind of talked about this one. It's just normally, we can skip that one. Let's go this one. I think this is neat because Sonu, the average year, and let's not forget the old joke about averages. There's a statistician. He put his head in a bucket of ice, his feet in the oven. They said, "Hey, how do you feel?" He goes, "Well, on average, I feel pretty good." Done. Hopefully, I don't know. I've used that before. Maybe you've heard it, but I think it's a good one. But the average year gains like 9% for the S&P 500. Okay, over a long enough cycle, you'll probably gain about 9%. Here's the thing: investors need to know, and everyone on the call needs to know. Average isn't so average. Well, we went back to 1950 here, and we're showing only 4 times in history because the S&P gained between 8 and 10%. So we'll just call that about an average year. Only 4 times. 21 times now, including last year, thanks to last year. The stock market's gained 20% for the year. 21 times the stock market's been down on the year. What I'm getting at, Sonu, the odds, if you want to call it that, of having a 20% gain are the same as just being down on the year. I mean, that's incredible. We do this for a living, but it's so important to remember that because it's that time of year we're doing it. This is an outlook call. We're giving our forecast. We all do this stuff. If someone said, we're going to gain about 8, 9%, maybe look at them a little funny because the odds of that are probably slimmer than you think. And again, that's why we think low double-digit returns. I'll tell you what, because we're going to get moving into the economy. We do like small caps. We like cyclicals. We like mid caps because we don't see a recession. We're going to talk a lot more about the economy next and some Fed. Oh, my goodness. Almost knocked my milkshake over. I was getting so excited. I started swinging my hand. That had been a disaster. Anyway, I don't want to do that. I just totally lost my track after I hit my milkshake. But there's a lot of different things that we look at that are still really, really positive. And I think it's just important for investors to indeed know that average is not so average when it comes to investing. I know you love this slide. You want to add anything there before we jump forward?
This is one of my favorite charts that you produce amongst the hundreds, literally, that Ryan produces. It basically tells you that, you know what, on average, returns are likely to be above average. So work that in your heads as you think about that, right? But no, there's some truth to that, right? And then if you think about, we could have a negative year, but then that's why we talk about the economy, right? Usually, not always, more often than not, you get big bear markets during recessions. Now, in 2022, that didn't happen. But, the Fed was raising rates like no tomorrow, right? The most aggressive Federal Reserve in 40 plus years. So, there's a reason why we got a bear market then. But we've come out of that, I think. Right?
Although I think we've definitely come out. So we are getting more questions about CPI and the Fed. You want to just jump ahead to the inflation slide? Let's give the people what they want. There we go. So this morning, Sonu, CPI came in 3.4 year over year, a little bit hotter, I guess. You look at the headline. Let's talk about this morning's number. I need time to dive in, but just big picture. What are we seeing on the inflation front, and how does it matter to the Fed?
So CPI is what came out this morning, the Consumer Price Index. Now, what we're showing here on this slide is actually PCE, the Personal Consumption Expenditures Index. That is what the Fed follows, right? So, just to keep that level set there. But CPI obviously comes out earlier in the month, so it gives some directional, tells you a little bit of what may happen to PCE. These things don't exactly track each other. But, I'll put it plain and simply, Ryan, I think the inflation problem is over.
Yeah.
Right. This morning we saw headline CPI at 3.4%, but that's year over year, right? And a lot of it, 2/3 of that is because shelter inflation, housing inflation, which is basically rents and something called owner's equivalent rent. Somebody asked about that. Owner's equivalent rent is, I own a home, you own a home. What the government assumes is that we rent the home to ourselves, right? So home prices are not in CPI or they're not in PCE, right? Instead, when we rent to ourselves, how does the government calculate that? They look at prevailing rents. So essentially, the entire housing or shelter inflation data is based on rents, right? So what's happening with rents? In the government data, it's coming down, but it's coming down very slowly. If you look at private market data, it's coming down a lot faster, right? In fact, seeing in a lot of cases outright deflation in rents. Right now, the government data is lagging by probably 12 to 18 months. So if you think about that, in this chart, even the dark green bar, right? Essentially, you can see that's what's holding up inflation now, inflation over the last year. And you look at year over year numbers. Whereas you look at take out shelter, CPI X shelter, Ryan, is running at 2% right now, if you look at the last 3 or 6 months. So basically, inflation's back at the Fed's target. Shelter, I think, is artificially, for now, keeping inflation elevated.
Good stuff. I know. Let's see. Maybe 2 slides away is the Fed. Let's go to that. We're just jumping around, and how it all connects to the Fed here. Because if we don't have a major inflation problem, let's put it this way: why did the Fed hike rates so aggressively from virtually 0% to over 5%? I mean, even they said they didn't expect to do it that much, but they did. Because they had to, because we had massive inflation, right? The terrible war that took place, obviously, all the supply chain issues, all these different things took place and caused over 9% year-over-year CPI inflation, in the summer of 22. But obviously, it came back a good deal. So if the Fed had to hike a bunch to slow down inflation, and I'll be honest, we don't need to go down this rabbit hole totally, but did the Fed really help solve inflation, or was it simply time to get these supply chains and China to get its act together? Believe me, you could talk to both of these things. But the bottom line, inflation is no longer a headwind. I don't know if it's a tailwind. It's probably the wrong way to put it, but it's not a headwind anymore. So why in the world do we still have rates over 5%? And when will they start cutting?
Yeah, that's a good question, right? Look,
it's one we think about every day.
Yes. Look, cuts are coming, right?
Trying to figure out when are they going to cut rates?
Cuts are coming because inflation's pulled back. I mean, look, in June of 2022, CPI inflation was running at 9%. The Fed, in response to that, took rates from 0 to 5.5. Now, inflation, as of this morning, at least year over year, I've said over the last 3-6 months, inflation's running closer to 2%. But year over year, fair enough, it's running just over 3%, right? 3.4%. So that's incredible. We've had inflation go from 9% to 3% in basically close to like 18 months. That's incredible, right? Now the Fed is still at 5.5. Will they cut? I think the Fed's told us they're going to be data dependent. They're going to look at the data and they're going to react to that. Now, the market's looking at the same data. All of us are looking at the same data. And we're saying, wait a minute, inflation's sort of, quote unquote, solved. Why is literally the question you asked, right? Now, the Fed is not going to tell us they're going to cut rates because the markets will take that and run with it. But I think even through the end of last year, right, we saw inflation data slowing. The markets are already pricing in. When we came into 2024, New Year's Eve, right, I was looking at the data. Markets are pricing in about 6 to 7.25% cuts, right? So cuts about 160, 1.6, 1.7%. Now, what's happened over the last 10 days, I think markets have said, you know what, we're probably a little too optimistic there. We got to pull things back, right? Now they're expecting maybe somewhere about 5 to 6 cuts instead. So there's been a little less optimism, but that doesn't mean the Fed's not going to cut. Now, the other big question is how early will the Fed cut?
Sure.
Right? I think up until 2 weeks ago, the investors are convinced that the first cuts are coming in March. You and I have talked about this. We've talked with the team. I always thought that was a little too optimistic. I'm still in the camp that, there's probably only like a 30-40% chance we'll get a cut in March, right? I think by May or June, we're likely to see the first cut. And I would say the chances of a cut in May is probably 75%. By June, I think we'll see at least one cut, maybe two, depending on how the inflation data goes. I do think the inflation data is going to come down even more. It's going to give cover to the Fed to start cutting. Now, with respect to all of 2024, do I think we'll get 5 or 6 cuts? I don't know. We are in the camp, as we said, we don't see a recession this year. The economy is going to remain strong. Maybe it grows along trend. So the Fed may not cut 5 to 6 times, but I could easily see them cutting, by 1% or so. That's 4 cuts, right? What do you think?
Yeah, no, I think that makes sense. 3 to 4 cuts, not starting until the middle of this year. I don't think I think that's just kind of how things will shake out. I mean, the bottom line again is if they hiked rates because inflation was so high, inflation's really not so high. Now, we want to see shelter come back. If you had to pick a problem or an issue with today's inflation data, I guess the shelter data, again, was a little stickier than we would have preferred. But again, we see so many reasons to expect that to break down low or come back lower due to what we've seen in the private data. But let's go back one slide, Sona, which I believe is a consumer. I think we had another question. So thanks for sending these questions. We're getting a lot of them. Keep sending them in. The consumer, again, 70% of the economy is the consumer. 1 year ago right now, when everyone was telling us there's a recession coming, you were showing some of these we just update these every month. I mean, we've been sharing these for a while saying, listen, consumption is strong, wages are strong, net wealth is strong, debt. There's a lot of debt out there, but you got to look at equity. Equity's also up a lot. So debt to equity is not as bad as it seems. Balance sheets in corporate America are good. Balance sheets in the consumers' households are pretty solid overall. Not an A plus, but maybe like a B plus. Talk to me about kind of some of these two, because I know the one on the right you've shared a ton, and it keeps going up and to the right. So I think that's good, right?
Yeah, both lines are going up really nicely. And look, by the way, shout out to Jamie Hopkins, as an old friend and current friend too. Hi, Jamie, and hi to everyone on the chat as well. That's awesome. Nice to see you here. Thanks for listening, I should say. But look, I think a simple way to think about what's happening with the U.S. economy, right? What makes up the U.S. economy? Almost 70% of the economy is consumption. Now, what drives consumption? Well, for the most part, it's incomes. It's not actually savings or, yes, net worth is a big part of it, but people have been spending out of incomes, right? Now, when inflation is high, in real terms, after adjusting for inflation, there wasn't as much spending. But what's happened over the last year? Inflation's come down. That's one. Yep. The labor market's still, really strong. There are very few layoffs, for that matter. Job growth is still, running around 165,000 jobs a month. The unemployment rate has been below 4% for 23 straight months. So incomes are growing, right? Incomes are growing. Inflation's falling. That means real incomes, inflation adjusted incomes, are going higher. That's what you see on the left-hand side chart. And that's what's driving the right-hand side chart, because, as real incomes go up or inflation adjusted incomes go up, consumption goes up. I think that's really the story of the economy right now.
It is. And listen, we get to work with advisors and our partners every single day, and we hear from them. We hear the concerns and client concerns. I get to travel the country and do client events. And I hear all the time, listen, like, the stuff I'm buying costs more. There is no doubt. Things cost more than it did last year. They cost more than 2 years ago, 3 years ago. Maybe there's something out there, TVs or something, that might be cheaper, but most goods and services do cost more. That's inflation. It's all about that relative. How much is inflation going up and down? That's what the market cares about, the year over year. So, when it was running at 9% this time, middle of summer 2022, that wasn't good. But year over year, inflation's really come back. And again, what Sonu, you're saying here, most people are probably making more in terms of their wage growth than inflation, right? And that's kind of why inflation, no one likes inflation. No one likes paying more for anything. Don't get me wrong here. But that's kind of why the consumer's been able to hang tough, you think?
Absolutely. I think that's what it is. And which is not to say there are people struggling. That's not to minimize any of that. Sure. But when you look at the aggregate economy, when you look at all workers across, on average, in fact, more than that, we are seeing rising real incomes. In fact, this chart shows that real incomes through October was up 2.7% over the prior 3 months, right? That's an annualized pace. In fact, once we got the November data, it's even stronger than that. It's close between 3 and 3.5%. So if you think about what's the maximum potential speed of the economy, right? Remember, I said that the economy is mostly based on consumption. So incomes matter, right? So then you look at, okay, what's the possible, how fast are incomes growing? If real incomes, after adjusting for inflation incomes, are rising around 3.5%, that's a pretty strong economy in terms of potential speed, right? I mean, I'm not saying that in real terms, we'll see real GDP growth growing 3.5%. There are other things that go on. That's, inventories, exports, things like that. These things can be volatile, but we're in a pretty good place with respect to the economy right now.
Well said. We're at the bottom of the hour. We wanted to keep this, maybe 30, 35 minutes. So we'll try to wrap things up here, but we would definitely want to keep going. So keep sending those questions in. Let's go 2 slides forward, Sonu. We'll go back one or back the manufacturing one, your favorite. There we go. So here we go. So let's talk about this. So the consumer was strong last year, surprising just about everybody. Even you thought the consumer would be strong. I think you were still a little surprised by just how strong they were. But manufacturing, it wasn't a rip roaring manufacturing. There are some positives. We'll talk about that on this slide. But housing detracted from GDP 9 quarters in a row. So housing and manufacturing didn't really do much to our economy last year. Maybe the consumer does pull back a little bit, right? Maybe they pull back a little bit. So tell me why it matters, because housing and manufacturing might pick up some of that slack, right?
Yeah, and this is where Fed cuts had an Fed rate hike. Sorry, what I'm already thinking about cuts.
yeah. It's that milkshake brain will do that to you. Yeah.
So, but look, this is where Fed rate hikes had an impact, right? The interest rate increases, it impacted housing. Mortgage rates went up, so housing actually dragged on GDP growth for 9 straight quarters. That's ending now, and in fact, look, markets price what's going to happen in the future, not the past, right? So markets already looking ahead, interest rates are falling, and we're seeing a pickup in probably the most cyclical. So that's going to go from a headwind for the economy into, I'm not going to say a tailwind, but it'll be nice if it just doesn't drag anymore, right? In fact, we could see a little bit of a pickup in new home sales, things like that. They add a lot to GDP because building a home adds to GDP growth, right? So that's positive. With respect to the rate outlook as well as interest rates fall. And then the chart on the right, as Ryan mentioned, that was my chart of the year for last year, manufacturing, construction. I mean, we've all been, I think, very negative on manufacturing in the United States for the last 20 odd years. Rightfully so, because a lot of manufacturing is left, right? It's not a big part of the economy. Maybe it's about 10, 12% or so. Manufacturing employment is also around there as a part of total payroll. So it's not a big part of the economy, right? Even in 2019, for that matter, we think of 2019 as a strong economy, but manufacturing was in a bit of a funk in 2019. Remember the trade war and all that, Ryan? So it wasn't like manufacturing was running red hot in 2019, no. But the consumer was, and that's what held up the economy at the time. All this to say, we don't think about manufacturing as a key part of the economy, but it matters, right? Because manufacturing employees tend to get paid more, all of that. The good news is there's a lot of things, especially from the fiscal side, that happen. You got the CHIPS Act, the IRA, the Bipartisan Infrastructure Act, all of that's gone into, I think, incentivizing private investment, right? Reshoring, bringing factories back. And, that's what you say. Manufacturing, construction spending, this spending on factories, right? That was up 100% over the last 3 years. That's incredible. By the way, that's after adjusting for inflation. What's driving that? Mostly it's factory construction of computers, EV batteries, semiconductor plants, things like that. That was up 900% after adjusting for inflation, Ryan. So that's incredible. I think that's a very underrated story in America right now.
No, it is. No doubt about it. And also, I think it's things you don't see in a recession, to see some things like that. And why, again, is it happening? Well, listen, when we had all the issues after COVID and China was on lockdown, shutdown, we needed our chips. We needed these things here. We said, you know what? Let's make them here. And I will use the F word just for a second, if that's okay. Fiscal policy, it doesn't have to be a bad thing. I know everyone has opinions on Washington, throwing money around, printing money. We hear it. We disagree with a lot of that, but we hear it. But there can be positives from Washington. And some of these bipartisan things you just talked about, like the CHIPS Act, like some of these other things, are bringing things back, and they're building these incredible factories that are going to be top-notch to create incredibly high-tech things for our country, which is kind of the next and final thing we're going to talk about when we get to productivity here next. Productivity is about to have a pretty big boom, we think, because of these things, but it's really exciting. Manufacturing was about half our country in World War II. Now it's, like you said, 10 to 12%. But it can be a big juice to the economy, and there are some real positives on the manufacturing and, honestly, housing front as well. So we should spend a little time, a little as in like maybe 1 minute, talk about bonds. I hate to not give bonds a lot of love, but, fixed income, we came into last year being underweight fixed income. We didn't see rate cuts. Everyone talked about this recession. We didn't see it. So we positioned our portfolios and our models to be shorter duration. I'm getting a little geeky on you, I know, but we thought bonds might not do all that well. We thought stocks would do better. That's how things played out. We think there's a little bit more opportunity in bonds here, though, right? With the Fed starting to cut. Let's talk about bonds for like a minute and then wrap this thing up.
No, exactly. Last year when we came in, we didn't see a recession. So we were like, you know what? Interest rates may still go higher, right? And so when interest rates go up, bond prices go down.
Right.
So we were like, we're not going to buy long-term bonds in our portfolios. We were holding cash, and we were earning 4 to 5%, 5.5% by mid-year in cash. And so we were like, why take more risk, right?
Right.
Now that changed as we went further down the year. We think, rate cuts are looming. And as I said, the opposite, right? If interest rates start to fall, bond prices go up, right? So now we've moved sort of neutral in terms of our bond positioning within portfolios. By neutral just means what our benchmark has, right? So we have more long-term bonds in the portfolio right now. So we think bonds will do somewhere between 5 and 6%. That's very close to, with bonds, when you thinking about how much should I expect from a bond portfolio? Well, just look at the yield, right? Yeah. The yield to maturity for bonds is probably a best approximation of the future return. And in this case, yield to maturities are around 5%, maybe a little tad higher than that. We think that's what you can get with bonds this year. Of course, we still like stocks better, and we are overweight stocks, right, Ryan?
Exactly. But again, believe me, we know a lot of people listening have probably a good amount in fixed income, right? And the way bonds had a historically poor 2 years. Bonds had never been down 3 years in a row. It was looking like we were going to be down 3 years in a row until the late rally last year when yields really started to go lower as the Fed again pivoted from their aggressive rate hiking schedule. So again, that's kind of the big picture. No recession. We think stocks are going to do pretty well, led by small caps, mid caps, industrials, and then again in the fixed income, you're going to get a little bit, 5-6% or so, but we still think stocks will do better. But so the final thing we want to talk about is productivity. In our country, I think it's the next slide, I believe. Yes, in our country, we have not had really strong productivity for an extended period of time. In a recession, like I think 2020, we had high productivity. You know why? Because that person worked over there, and person worked over there, lost their job. If you still had your job, you had to work twice as hard, right? Productivity goes up in recessions. But now, what do we call that? Empty calorie productivity. I think that's how we call that. Now, we're getting some good calories. And I don't know if this is good calories or not, but I'm going to say I enjoyed it. But now we're seeing some good calories on the productivity side of things. You want to talk about that, and then we're going to wrap it up.
No, even over the second quarter and third quarter combined, productivity is up, 4.5% annualized pace. That's the fastest pace of productivity growth outside of recession, post-recession periods. Like you said, during recessions, it looks like productivity goes up, but like our friends at Employ America say, that's empty calorie productivity gains, right? That starts to go down once everyone starts to get rehired. But no, the last 2 quarters, Q2, Q3 of 2023, we saw the fastest pace of productivity growth since the mid-90s. And remember, the mid-90s is a good time for productivity growth, right? Yes. Look, what productivity growth, that's a game changer, right? That's because productivity growth can boost wages while keeping inflation low, right? Because strong wage growth, actually, it's good for all of us, but the Fed worries about it. Because they think, if I get a higher raise this year and even bigger raise next year, I'm going to go ahead and spend more stuff. They're probably right on that, right? But and so they're going to keep rates tight, right? But at the same time, if wage growth is high and that's coming from higher productivity, that means inflation could be lower as well. And what it does is it allows the Fed to ease up on rates. And if rates go down, we were talking about manufacturing investment before this. That could boost business investment across the board, right? What do you need for better productivity? You need businesses to invest. So long story short, if you have higher productivity, you can have strong wage growth with relatively low inflation. And it can create this positive feedback loop between monetary policy, what the Fed does, and productivity as well. Like I said, strong productivity growth that's accompanied by low inflation can lead to more expansionary policy. That can lead to greater investment, a tighter labor market. Remember, labor is business's biggest investment. It's not the only one, it's the biggest one, right? And, when you have a tight labor market, businesses are like, you know what? Yes, I'm going to hire more, but I'm going to think about making maybe technological investments as well. That can fuel further productivity growth, right? And that can signal to the central bank that, maybe we can keep rates low. That's literally what happened in the mid-90s with Alan Greenspan, right?
Well, that's what I would say. Mark Twain said history doesn't repeat itself, but it often rhymes. I like to use that. In the mid-90s, 94, the Fed hiked rates aggressively. Upset the apple cart. Orange County went under. It was it was a scary time. Sound familiar? The Fed just hiked rates a lot. We lost the 16th largest bank overnight. A couple different regional banks went away. But then in the mid-90s, Greenspan realized productivity was strong. And that opened the door for him to cut. And again, inflation was not going to be a problem and wage growth is going to stay high. And usually the Fed is worried about what? Higher wages, because maybe there's higher inflation. But like we just laid out, if productivity is high, that's not usually how that works. So if we have another scenario like the mid-90s, listen, we're not calling for multiple 20% gains like we saw in the mid to late 90s. What we are saying, there are some real positives that are out there in the economic front that I don't think a lot of people are talking about. And we've been talking about them a lot here on the Carson Investor Research team. And we've been bullish for a while. And we still think there's good times coming. I do see a couple questions. So thanks.
And speaking of productivity, this is another area. Our views on productivity is a big theme in our outlook, actually, which will be available on the Carson Group website or Carson Wealth website as well. Hopefully I said that correct, for download. The actual document, right? It will be available. If not, I think it already is. So we'll try and get a link out there. But the other thing,
definitely the webinar and a blog on the Carson Wealth website. And any advisors that are out there, you can get you can download the whole thing at carsongroup.com is where you can download as well.
Right. Productivity, like I said, it's a big theme in the outlook. And I think it's another area where we are not seeing eye to eye with everyone else. I think everyone else, including the Fed, by the way, still expects, fairly low GDP growth over the next several years. And a big piece of that is because, productivity is expected to be lower. So we're taking kind of a contrarian view there. We think, and this is a US-centric view, right? Because there was a question, hi, JJ, from UK. Your thoughts on international equities? Over the short term, we are actually neutral on developed market equities. We like U.S. equities. We overweight U.S. equities, recognizing also that it's easy to have a home bias, but we think the U.S. economy will run stronger than the rest of the world, especially emerging markets, right? So we are highly underweight emerging markets, thanks to mostly because of slowing growth in China. But we think even over the next several years in our strategic portfolios, we are overweight equities, but we are overweight US more than the rest of the world.
Yeah, I mean, this time a year ago, a lot of people were saying you wanted emerging markets, you wanted to own treasuries, longer-term bonds. Those things didn't play out, and we still think there's some reasons to they will continue to not play out. One question came in about what level would the S&P go to turn you bearish. I don't know if we're necessarily looking at S&P levels, to be honest. I mean, Sonu looks at these things every single day. He breaks his data down incredibly for our partners and for their clients every day. So we do want to see some weakness from the macro point of view. But what I like to say is I like to look at market breadth, right? One of our big themes about this upcoming year is a lot. Last year, what did you hear? Only 7 stocks going up. Only 7 stocks going up. The Magnificent Seven, the big 7 tech names that are out there. We kind of disagreed with that, but that's the technology had a huge year, up like 40 to 50%. Communications also. Now we're seeing a broadening out. Okay, that's a real positive sign. As this bull market ages, as the different things take the baton, you don't want just 1 or 2 groups to be leading, right? And again, when you're too geeky with this, I look at things called advanced decline lines. It's a total cumulative, how many stocks going up versus down. Keep it real simple. When those are going up, that's really bullish because a lot of stocks are participating. That just hit like a new all-time high just the other day, okay? Back in the late 90s, that rolled over. Back in 2006, 2007, the advanced decline line started going down while the stock market was going up. It was a signal that something was off, something was wrong. There weren't enough stocks going up to justify an overall bull market. Good thing we're not seeing that at all right now. So I want to see that first before I became quote-unquote bearish or even more neutral. Also, we look at the credit markets. Again, keep it fairly simple. This is free data. You can find it. Credit spreads on things like triple B spreads, investment grade corporate spreads. Think about it. If things are really bad, you're going to want to pay more for debt. I mean, you're going to charge a little bit more for debt. That's just how it is because you're worried that company might not exist. So pay me a little bit more for your debt. We are not seeing fear, stress, worry in the credit markets right now. So until I see stress in the credit markets, until I see less participation, that would change at least my particular view. And then if Sonu, the macro stuff he looks at starting the weekend, hopefully all those things will come together and we'll start to change. And maybe we don't go bearish. Maybe we look at utilities, we look at staples, we look at healthcare. And I want to be clear, that's not our views. But I'm just saying there are some different ways we can massage things, maybe going more bonds or gold. There's different ways we can do that. But that's kind of how we see that. So anything to add on that one?
It really is about putting a lot of puzzle pieces together, right? We're looking at the totality of data. Even if you just take the labor market, we're looking at the totality of data there, not just the unemployment rate, right? This morning we got initial claims for unemployment benefits. That's running really low, which means the labor market is running solid, right? Despite, other indicators that may show a bit more of a mixed picture. But then you look at manufacturing and that's why we have our own leading economic indicators that combine it all into, one story for us to look at. And then all the amazing stuff that Ryan does, right, with respect to what's happening in markets. You don't want to ignore markets because that's your biggest signal. That tells you what everyone else is thinking about, right? So, and Ryan, to that end, this is a good question by Minerva Capital. Small caps have started, they started 2024 weak. We already mentioned we like small caps relative to large. It'd be small and mid, I should add, right? Any thoughts on this weakness we've seen over the last 10 days?
Sure. I mean, we do still like small and mid, and they have pulled back a little bit. I think it's important to remember, though, what just happened, right? The last 2 months last year, the Russell 2000, so that's small caps, gained almost 22% the last 2 months. That's November and December of last year. What in the world does that mean? Well, I took a look, Sonu, at the greatest 2-month rallies ever. That's the third. That's the third best 2-month rally ever. So again, okay, well, maybe we're due for some near-term consolidation, near-term indigestion. Perfectly normal when you have a move like that. But here's what I think people need to know. 1 year later, after we've seen huge 2-month gains like that, I looked at the 10 best 2-month rallies ever on the Russell 2. 1 year later, at Russell 2 higher, 9 out of 10 times, up 27% on average. Those are just some numbers, some ways to look at it. But as we laid out, we don't see a recession. We see a Fed that's probably done cutting or done hiking, going to start cutting. That's probably going to be more of a tailwind versus a headwind. Oh, by the way, small caps are historically cheap relative to large caps. The honest truth is a lot of these large caps are kind of pricey. Tech, we're more neutral. Tech's pretty pricey right now because it had a huge rally. You know what's not so pricey? Your energy, your financials, your small caps, your mid caps. There are cheaper parts of this market. So if someone's waiting kind of for a fat pitch to buy something a little bit cheaper, your fat pitch might be small, mid, and some of those cyclical areas that look pretty good right here and now. Let's start wrapping things up, Sonu. This is a good one. Volatility.
Yeah, I pulled this up because
go ahead.
We're seeing small cap volatility, and this is another chart I really like, just to remind people that, look, volatility is part of investing, right, Ryan?
Yeah, I mean, they say the stock market's the only place things go on sale, yet everyone runs out of the store screaming. Last year, we saw a run-of-the-mill 10% correction into the end of October. As you see here, this thanks to our data from our friends at Ned Davis Research, you see a 10% correction on average once a year. You see, let me look here. It's 7 separate 3% dips. You see multiple 5% dips. You see bear market about every 3 years. I mean, these things happen. The truth, again, is have a plan, right? You need to have a plan. That's why a lot of you work with financial advisors. So many great financial advisors. Carson Wealth is obviously one of the best financial advisor groups out there. Not that I'm biased or anything, but, you think about it, you need to work with an advisor because they're going to help you, right? What did, I think it was Eisenhower said, plans are useless, but planning is everything. I say, like, print this one off. Put it on your desk. Look at it because stocks do come back. There's going to be even some of the biggest bull market years we've ever seen in history. They've had scary moments. Last year, stocks gained 26%. How scary was it most of the year? Now, believe me, it's all relative, but there was a lot of fear out there. There's a lot of headline risk out there the whole time telling you why you shouldn't be invested in stocks. Yet we were quietly over in the corner saying, no, there's reasons to be invested in stocks, but just have that plan in place that this year very well might have a 10% correction as well. It just kind of happens a lot of years, but you can still have really good gains. I think it's so important to have that plan in place ahead of time. Sonu, you want to add anything? Or I think we have one more after this.
Yeah, I'll put this in perspective, right? Over the last 4 years, 2019 to 2023, the S&P 500 is up 106%, somewhere around there, right? The S&P 500 total return, including dividends, right? What's happened? That's come in the face of what? 2 bear markets, 2020 and 2022. You've got, I don't know how many 5%, 10% corrections, pullbacks, whatever you call it. You got a worldwide pandemic, a really aggressive Federal Reserve that took rates from 0 to 5%, and the highest inflation in 40 plus years, right? Despite that, the S&P 500 is up 106% since 2019, right? That just tells you everything.
That does. I mean, the Dow started trading on May 26th, 1896. We've had multiple wars. We've had 2 100-year pandemics. We've had a lot of bad stuff. The Dow's come back to new all-time high every time. We said this past bear market wasn't going to be different. The next bear market, I don't think it's going to be any different. You're going to have more bear markets. You live long enough. You do this long enough. It's going to happen. There's going to be bad things that happen. Just remember the quote, though, right? It's always darkest before the dawn. when it's really dark, when it's really scary, that's again when you can work with your financial advisor to have these plans in place ahead of time. But you don't want to be panicking. You don't want to be selling. You don't want to be getting out. You want to be using it as opportunity, maybe not to panic, just don't sell, or maybe even step into and add some risk when everyone around you is telling you should sell. That is how you create a lot of long-term wealth. It's the opposite of how our brains are wired, but history has told us time and time again that is usually how you should look at things. So let's see. Yeah, there we go. Match with the Carson Wealth Advisor today, carsonwealth.com.
Yeah. I'm done with my milkshake, by the way, so we probably have to wrap now.
Yeah, we probably let's see any other last minute questions. It doesn't look like it. I think we're in the clear. Well, Sonu, you go ahead and say a few words. I'll bring us home.
No, thank you for listening, and the outlook will be out there. Keep looking at the blogs, all of that. Look, we want to take you through this process. One thing is we want to be transparent with what we are doing, right? That's why we continuously talk about that, share information with you. And I think what I mentioned at the top was we do things a little differently in that, not only are we looking at markets and the economy, we're making investment advice out of that, right? And giving it to advisors. We have an amazing advisor community at Carson. So definitely take a look at that. I'm very appreciative of being part of the community. And Ryan, chatting with you every day.
Yeah, no, it's fun. That's for sure. I'll just say this. There's a lot of news out there, some of it good, some of it bad. There's lots of different things. We're just honored that so many people took the time to listen to what Sonu and I and our investment research team has had to say about the world this year, about the world last year, maybe as we go into the future. I like Sonu said, there's so many different smart people out there, so many different research shops. What we're trying to do is be the most transparent one, right? We're right, we're wrong, whatever it is, we're going to keep telling you how we see it. We're never going to surprise people with some out of the blue call. Hopefully, if you follow us long enough, we do have a really popular podcast. Hopefully I can plug it. Facts versus Feelings. You can find it wherever you get your favorite podcast. Weekly stuff. Sonu and I talk about all these things. So there's just so many things out there, but we're just honored again and delighted that you took some time with us. And please check out Carson Wealth, carsongroup.com as well. There's so much information that this wonderful company hopefully can have help so many people out there continue to find their freedom and continue to invest for the future. So with all that, everybody, go get a milkshake. Happy 2024. We'll see you next time. Take care.